So why is one of the biggest barriers to building wealth, perhaps in your head? We're going to talk about some of those cognitive biases that people have that prevent them from accumulating wealth over time, and give you some easy strategies on how to overcome those. Plus, we'll also talk about some of the missteps that people find themselves taking as they transition from working to retirement, and of course, how to avoid those pothills on life's journey. So all of that coming up here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries as well, along with a variety of expertise across the team. They all stand ready to help you improve your life with a successful and cost-effective financial plan. Speaking of members of the team, let me start off the program by saying thank you to two members of our team, Chet Cowart and Kristen Costello, that hosted the program last week. We appreciate the opportunity to enjoy a day off from the program. They did a great job. If you listen to the program, I did, because of course I went to our podcast channels and was able to download and listen to it and get a good perspective on what it is that they talked about. But if you missed the show, I would encourage you to seek it out on your favorite podcasts platform or even on our YouTube channel, because it really was a pretty informative conversation about the top 10 tax changes. Now, that's an annual exercise that we've been doing for probably 20, maybe 25 years. Back in those days, I was the author of that. These days, Kristen authors that document. And what I found interesting about the conversation was really the discussion about this Form 1099-K, which is a form that various online platforms like Etsy, Venmo, all of that are sending out this year. And in particular, millions more Americans are going to get forms from these platforms and really not have any idea what to do with it. Of course, this form originates from the notion of when you sell items on a platform like an Etsy or an Amazon, or you do monetary transactions through Venmo. Maybe you're selling tickets on Ticketmaster. Maybe you had some extra Taylor tickets, sold those, made a ton of money on them. The problem is that the IRS kind of wants to know that, and now, courtesy of this Form 1099-K, they will know that. And guess what? They expect you to report the profit that you got on the resale of your Taylor tickets as income, and then correspondingly pay taxes on that. So here's the change, and it's been gradually changing over the past few years as the ultimate rule of if you have transactions, gross transactions, that total more than $600, then you're going to get this form. Now, the IRS hasn't quite gotten to that level yet. They've been gradually introducing this Form 1099-K. A couple of years ago, the threshold was $20,000. You had to be above that number in order to get the form. This year, it's down to $5,000, again, on its way to $600. So gross amount of $5,000, that is something that you need to be on the lookout for. The gain on a transaction like that, so we'll use the easy example of you bought your Taylor tickets for $1,000, you resold them for $3,000, you got a $2,000 capital gain, you got to report that, and you got to pay taxes. Now, if you made the mistake of buying Taylor tickets at the top of the market and spent $3,000 and then couldn't go to the concert for whatever reason, and you resold them for only $2,000, guess what? you don't get to write that loss off. Hey, I don't make up the rules. I just explain them. But yes, that is how it works. Remember the key takeaways then from their conversation last week. And I think this is why this is so important, because this is our first show in the month of February. So you're getting a lot of those tax forms in the mail. The reality is that you're probably not going to get these in the mail. These are from online kind of platforms. So you're going to have to dig around in your account to find the tax document. It's there. Make sure you find it, because it has gotten copied to the IRS. And you certainly do not want to ignore that. It's unlikely that for many of these platforms that this 1099 is going to just magically come in the mail, because these platforms are all kind of online. So you got to look for that tax form. So just a really important discussion by folks on the team at Nelson Financial Planning, Kristen Costello and Chet Cowhart last week. We encourage you to really kind of dig into that as well. I think that's our featured blog post as well for this coming week. So a lot of ways in which you can kind of check into that simply by visiting our website at Nelson Financial Planning. So I guess we got to shift to one of the headlines this past week because it had a particularly major impact on the markets on Monday and frankly throughout the week. So this headline involved this Chinese AI, artificial intelligence company by the name of DeepSeek, which seemingly was able to create an artificial intelligence model that appeared to perform on par with some of the more cutting edge counterparts from either Microsoft or OpenAI. And the twist, if you will, and what surprised everyone, and then correspondingly the markets on Monday, is that it involved a little bit of creative engineering that ultimately meant that it didn't need as much power or didn't need some of the more sophisticated chips that were out there. And of course, that then meant that the sort of the upshot is that the AI models of the future, well, they might not require as many of those high-end chips, i.e. those chips made by a company by the name of Nvidia, than perhaps originally projected. And so as a result, there was a pretty significant decline that was really concentrated in kind of these big tech companies, these companies that have a heavy presence in AI, Nvidia chief among them. A really bad day for Nvidia. On Monday, Nvidia, that company experienced the single largest one-day loss in market value for any publicly traded company in the history of the market. Now, granted, Nvidia had gone up tremendously in terms of value, and a decline of 17% obviously translated to a tremendous decline in terms of actual value. All of that got kind of wiped out on Monday. Nvidia made a little bit back as the week progressed, but still not anywhere near of kind of where it went into the week. So what's that all mean, right? So what does that all mean for the portfolio, and what's kind of the takeaway? I think the single biggest takeaway on all of that is something that we've been saying on the show for as long as we've been doing the show, and that is stressing the importance of being diversified. There's way too much focus on sort of the small handful of tech companies that have really been driving the sort of the overall market. And the overall market, particularly as an investor, if you don't own a lot of index funds, then you've got a little bit more of a concentration in that particular sector, in that particular category. And so bottom line, and this is something we said on the show 2 or 3 weeks ago, sort of at the start of the year is a good time to review your investment allocation. That's certainly something that you want to do. And I think the headlines this week really underscore that concept of why it is important to do that. Make sure you're rebalancing on a regular basis. This is really the kind of headline that sort of comes out of nowhere. A week ago, nobody even really knew, had heard of DeepSeek, and then all of a sudden, you've got a headline that then creates a disproportionate impact on your portfolio if it has not been rebalanced and double-checked in terms of its allocation. So with that, we're going to take a break and continue after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. In the previous segment, we were speaking about some of the potential barrier to building wealth in your portfolio if it's perhaps gotten a little bit more concentrated in some of these big tech names. You certainly have felt that this past week with the big headlines involving this AI company out of China that sort of reset maybe what the expectations were for some of these large technology companies, particularly that big chip maker, Nvidia. The reality is that one of the other significant issues in terms of building wealth may very well be you, specifically your head. According to a recent study, one of the biggest barriers to building wealth for people who are not in the markets or who have never really invested before is that far too many people, investing is seemingly pretty complex. And if you think about this, like according to a survey by the folks at Janus Henderson, nearly half of all U.S. adults, 48%, report owning no investable assets. That's a tremendous amount of procrastination. But the root cause of that really could be sort of this cognitive bias known as complexity aversion, where investing is just too complex, too hard, and at the end of the day, you just don't do it because you just don't understand that. I think overcoming that and moving on can certainly help to build wealth over time, but on a very basic level, people may typically put off doing these essential financial tasks. In essence, kind of have the same fears as those who can't really bring themselves to maybe start an exercise routine, right? So, you walk into the gym, there's a bunch of machines, who knows how they all operate, and you turn around and walk out. Investing is kind of like that, except on steroids. I guess that's how that compares to the gym analogy. But certainly you could say that about today's investment choices. People don't want to make a mistake or feel foolish because, when you have that complexity aversion, that concern about, this is, might be a little bit too complex, then it also, of course, because it's your money, right? It's closely tied to another sort of mental bias, cognitive bias known as risk aversion, right? Risk aversion is the concept of, wait a minute, if I've got money, I don't want to, do something with it and then run the risk of losing a chunk of it or all of it. And so those two combine to really be a pretty significant impact on the ability of a lot of Americans to accumulate wealth over time. So all of that kind of in your head or in people's head. And so the question becomes, okay, well, how do you get past that? How do you wind up overcoming some of these cognitive biases that everybody has just by virtue of being a human being to really help move past this? Because when we talk about half or nearly half of the population not having any investable assets, that's not a good thing because it's not like there's pensions running around at every employer like there used to be 50 odd years ago. It for the most part is up to you to ultimately save money over the course of your working career so that you have some form of a retirement career as well. So what can you do? We got 3 takeaways here on the program that we want to talk with you about. So the first is to start small. In other words, that's kind of like at least do something. right? Do something, as we all know from an investment perspective, time in, meaning if you put money in early in terms of investing, then it gives it more of a runway to ultimately compound over a longer period of time. The sooner you put that money in, then the longer that runway, the more ability of that money to compound. So the reality is that the longer you have to invest, then the more then that money has the potential to grow. And you can certainly start small. I know we start accounts at the office at Nelson Financial Planning. Those can be set up for as little as $25 a month. And we're not certainly the only institution that provides that. Plenty of options in terms of being able to set that up. The only caveat there is just kind of watch out for those institutions that only want to help you if you have $500,000 or $1 million. You know, you've seen the ads, come contact us if you've got a bunch of money already. Not sure how that is probably helping people at the end of the day, but just make sure that when you are trying to get started, at least get started with something, and know that a lot of these types of accounts that you can set up, whether it's an IRA or a Roth or just a regular investment account, can be set up with as little as $25 a month. They can be set up with an automatic withdrawal out of your checking account, so you can really automate that, just like the gym membership or just like the Netflix membership. And frankly, at $25 a month, it's probably less than what some of the gyms out there are charging these days. So that's key takeaway number one. Do something. Start with something. Even if it's a small amount, it's okay. It's better to at least have started and be doing something than doing nothing at all. Number two, take advantage of the opportunities that are immediately around you. Look at your employer. Chances are that they offer some type of plan, and most will still offer some type of match. Here's another surprising statistic. Nearly 46% of workers either contribute less than the employer match or don't contribute at all. That's like not taking free money. I mean, how a match works from an employer retirement plan perspective is you put in a certain amount of dollars. If you put in a certain amount of dollars, the employer is going to match it with another sum of dollars. That's not your money, it's their money. And typically there is a maximum level that they'll go up to in terms of doing those matching contributions. So if you're below that level, again, you're not getting all of that free money, because after all, it's not your money, it's the employer's money that's coming in as a contribution. So make sure that you're looking around. If you're looking to get started, take advantage of what's around you. Look at that employer plan, figure out that match, and by all means, make sure you're at least contributing enough to get all of that employer match, not just a little bit of it, but all of it, because that's a great way to increase the value of your account, to really help you compound those dollars over time. And then lastly, of course, get educated. There's a bazillion resources out there. Make sure you get sort of the full picture when you're going out and getting educated. Getting financial advice from like TikTok, probably not a good idea. Kristen Costello, our fellow associate and partner at Nelson Financial Planning, talks about the story of how someone took the advice of converting all of their IRA to a Roth off of a TikTok video and then wound up, having a giant, massive tax bill. So, so yes, there's a lot of resources out there. Don't just take the ones that are going to be like 20 seconds. Really, as with anything, if you're going to do a good job on it, make sure you're taking the time to become educated about what your financial choices are. It does require an investment of time, and that's why we do the program. We do the program every week, so you can check us out on our podcast channels. You can check us out on our website at Nelson Financial Planning. And then don't forget our book, Next Gen Dollars and Cents, obviously available on Amazon, also available to anyone who comes in and takes advantage of a free consultation at the office at Nelson Financial Planning. planning, usually the folks out front will kind of slip you a free copy. So that's kind of the easy way to do it, and then you don't have to pay for it on Amazon. So, but anyway, to learn more about all that, check out our website, nelsonfinancialplanning.com. We'll take a break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. There's no greater transition in life than when you go from that accumulation phase where you're working and you're saving dollars and preparing for a period of time when you're not going to work. And then you transition and you effectively go from the accumulation phase to this distribution phase. And along the way, though, given how significant of a shift that is, there's certainly a variety of potholes that can pop up that can really serve to undermine the quality of that transition. So in this segment of the program, we wanted to take some time and sort of talk through some of the bigger ones, some of the more important ones that you need to really focus on if you are approaching this type of transition when you are leaving sort of the workforce and shifting on in to retirement. As you might expect, the conversation really does start with getting a handle on your expenses. Now, the funny thing here is many people have never really done a budget while they're working, but when you make this transition, you probably want to sit down and at least sketch up some kind of a cash flow perspective for what those expenses are going to look like in retirement, because a lot of people really kind of fail to give that a proper perspective. The reality is that things like health insurance, taxes, free time expenses, we've certainly talked about those categories on prior episodes of the program. Those are big numbers. Okay, if you're trying to retire before the age of 65, for a married couple in their early 60s, health insurance can often be $1,500 to $2,000 a month. After 65, which is when you become eligible for Medicare, there's still a cost if you go the traditional way of Part A, Part B, and get a supplement, and then Part D for the drugs. That's still going to be about $800 or so for a couple. So those are significant sort of line item numbers that you probably haven't been having as a line item expense during the period of time while you've been working, because for the most part, a lot of employers will take care of that, or certainly take care of a pretty good chunk of that as well. And then by virtue of you being part of a group plan, right, then the costs spread among a larger number of people, bringing those costs down. When you shift to retirement, it's just you. There's no group retirement healthcare plan. That's called Medicare, and that one doesn't kick in until 65. So understand the impact that health insurance is going to have in terms of your overall expenses. And then, of course, you got to remember the taxes, right? When you're working, I think everybody's used to seeing the net number. That's the number that goes into my checking account. I don't worry about it beyond that. But the reality is that in retirement, you need to account for those taxes as part of your income. We're going to have some more thoughts on that piece here later on in this conversation. But and then, of course, lastly is the free time expense, right? That's the reality is that's probably going to be higher during the first part of your retirement, because when you retire, you'll be the youngest age that you will be in retirement, right? Every day we get older, that's the reality. Here we are, it's already February. I don't quite know where the first month of the 2025 year went, but the reality is that when you do retire, you're more likely to use it as an opportunity to do things that you maybe haven't had the opportunity to do because you're working. And oftentimes those things require money. So what we typically see is when somebody first retires, there's a greater need for income. There's a greater need for resources and money because they're doing more. So that's an important thing to kind of put into the mix. I think far too often people kind of think of those expenses of travel and whatnot as sort of a constant expense. The reality is what we see is that those are much higher, at least early on in those first few years of retirement. So make sure you really kind of have properly accounted for that. That's why the notion of creating at least some form of a budget as you're starting to make that transition into retirement really helps to bring perspective into some of these numbers that you don't necessarily see while you are still working. And then, of course, don't forget about inflation, right? That's always there, typically runs 2-3% per year. Over a 10-year period of time, if inflation is running at 2 or 3%, you probably need 30%, maybe even 40% more money in to effectively have the same purchasing power, given that the impact of inflation, just like anything else, is compounded, right? If inflation is 5% one year and then 5% the next year, well, then your inflation effectively over those first couple of years is going to be north of 10%, not the 5%. So remember that compounding impact of inflation is pretty important, just as it is equally important in terms of your investment results over time. The same thing is happening on the inflation side as well. And then, of course, having the right investment mix makes this list of potholes to avoid on the transition to retirement. That always makes the list of anything. We were talking about that earlier in the program about you certainly want to have a good handle on your investment allocation, particularly in light of some of these headlines that came out of China just this past week involving DeepSeek and some of the AI changes or models that they have been able to produce, which certainly adversely impacted particularly that sector of the overall market. So you want to make sure you have balance when it comes to your investments. You want to make sure that you're diversified, certainly have some parts that are conservative, some parts that are more growth oriented, but try not to go too far on that. I think that's an issue that we see where more and more folks will push more and more of their allocation of their investments into the more conservative side of things. And while it's certainly good to have a portion of any portfolio that has that more conservative side, you've got to think about life expectancies. You've got to think about inflation. The reality is you could very well end up in retirement for 3, maybe even 4 decades. And certainly, your retirement time period could certainly be as long as the amount of time that you spent working and accumulating those assets. So you have to have some positions or some allocation that is designed for growth over time, particularly to keep track of longevity, to keep up with longevity and inflation. So, in terms of what that number is, I mean, obviously that is unique to the individual. We like to think of it in terms of income and how much income am I drawing out of a portfolio? Well, kind of the normal rates of income that you should be drawing out of a portfolio should be around 4 or 5%. And so if you think about it in terms of years, right? So how long might I have to go and sort of really relying or leaning heavily on the conservative side of the portfolio because there's some headline or market decline or whatever? So how long is that? Is that 4 years? Is that 5 years, 6 years, whatever the case may be? You do the math, say it's 6 years times a withdrawal rate of 5%. Well, that's 30%. So that's not 50%. So be careful on your investment allocation, particularly when you transition to retirement. We're going to take a break here and continue this conversation after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about some of the potholes that you might encounter on that major life transition from working to retirement, from that period of time where you're accumulating assets to the period of time where those assets are now getting distributed out to you to help provide income to cover your expenses. In the previous segment, we were talking about the importance of kind of starting out that process with getting a handle on your expenses. If you're a regular listener to the program, That's, of course, when we bring up the B word, that is budget. Budget is always a good way to get a handle on what those expenses might be, particularly in retirement when you make that transition, because oftentimes there's 3 different expenses that you might not be seeing or appreciating as much while you are working, because those are kind of taken care of along the way. We're talking specifically about health insurance, which obviously is a major cost. If you're working for an employer that provides health insurance, then you probably don't think about the cost of health insurance. But if you're retiring, you better be thinking about that cost of health insurance, particularly if you're under 65, when the cost is much, much higher. Above 65, congratulations, you're eligible for Medicare. But there's still a cost to that. On the traditional side, Medicare for a married couple between Part A, Part B, a supplement Part D, you're probably looking at north of $800 a month. So not nothing, if you will, in terms of that cost. And then taxes, right? Taxes, most people don't think about them along the way because you're getting paid a W-2. There's taxes that get withheld out of your paycheck each and every paycheck, and you don't necessarily see that. Your employer takes care of it, sends it off magically to the IRS, and you get your W-2, and that's that. The reality is, in retirement, well, you're generating your own sort of W-2, if you will, and so you need to make sure that you are properly accounting for and doing withholding along the way in order to make sure that those taxes are covered. And then lastly, that free time expense. That's the notion of when you are younger, you're going to spend more money in those first few years because as a younger person, in theory, you are more active than you will be when you're in your 80s. And when you're more active, you do more things. And let's face it, things cost money. We also talked a little bit about having the right investment allocation, thinking about it from more that withdrawal perspective. I think that's how we like to think of it in terms of determining just how much needs to be on that conservative side of things. Because the conservative side of things in a portfolio, remember the purpose of that is to provide you income when maybe the headlines of the stock market are not behaving. So you got to think of it in that respect and not just use some of these more simplistic formulas of, I'm going to take my age, subtract it from 100, and that's going to determine my investment allocation. Don't do that, because those old formulas don't really take into account life expectancies being what they are. And then, of course, let's not forget our little friend called inflation. Typically does run at 2 or 3%, which if you look at that over a 10-year period of time, you're going to need 30% more money, at least, in terms of being able to have the same purchasing power that you did 10 years previously. So need to make sure that your investments are positioned at least to have some growth. And then to talk a little bit more about the tax side, which of course is very much on people's mind. We're about ready to enter into full-fledged tax season, particularly around the office at Nelson Financial Planning. So that topic clear, front and center for many, many folks. Remember, when you retire, you do have to account for those on your own and have those withdrawn out of your income in retirement in order to properly account for that with the IRS. Your paycheck today that you get, right, is net. And in retirement, you sort of need to work with the gross number in order to then make the proper election of how much needs to be withheld on that gross amount to pay the taxes and make sure that that's the right amount. That's why, as part of the team at Nelson Financial Planning, we have tax experts, some of which are even CPAs or IRS enrolled agents that are part of the team full time. You had the opportunity to listen to them on last week's program, Kristen Costello, Chuck Cowart, talking about the top 10 tax changes and how you ultimately implement them into your overall financial plan for this year. And then lastly, let's not forget a big item of income in retirement is Social Security. Make sure that you make the right decision when it comes to Social Security. There's all kinds of conversations online about this. 3 things that you need to know. Number one, it is going to be a big part of your income in retirement. I mean, a lot of people will say, it's Social Security, it's going to be there, not be there. It's there. and it still contributes quite a bit of that income for most retirees. So no, that's a big part of your income, so it's pretty important. It's taxable, and for the most part, unless your income is quite low, then it's not taxable. But for most Americans, they do find that taxable because the thresholds that existed to determine the taxability of your Social Security have not changed in over 40 years. And those thresholds were never indexed to inflation like pretty much everything else in the tax code. That one wasn't indexed to inflation. So what that means is that more and more Americans are seeing that their Social Security is taxable because those thresholds were set 40 years ago, not indexed to inflation. And so that is picking up more and more Social Security income to be taxable. So know that it is taxable. And then lastly, the decision that you make on Social Security is permanent. Once you elect to take it, you don't get to change your mind on it. There's a limited exception if it's within the first 12 months, but it's permanent otherwise. And I guess the key there is if you haven't saved enough for retirement, then really looking at the possibility of waiting before you decide to collect Social Security may be very well in your best interest. The amount that you're going to get from Social Security goes up. It goes up and up and up until you get to age 70. And then once you get to age 70, it does not go up anymore. So some important things to be aware of when we think about Social Security and the role that that's going to have in your transition from working to retirement. So another full episode as we start to wrap up and conclude here on the program. Don't let the complexity aversion bias, basically your head, derail your financial future. We were talking about that concept earlier in the program. Certainly investing can seem complicated, but there are some things that you can do to overcome those issues. So we gave you 3 key takeaways earlier in the program. Number 1, do something. Start small. A lot of accounts can be set up for as little as $25 a month. Certainly, we do that for anybody at our office at Nelson Financial Planning. Number 2, take advantage of kind of the obvious opportunities, specifically that employer match. A lot of employer retirement plans will have matching contributions. So make sure that you're at least contributing money and doing as much up to that contribution limit as you can, because at the end of the day, that really is free money that you want to take advantage. And then lastly, make sure you're getting educated, right? A lot of options out there. Maybe stay away from those, 15-second educational videos, because I don't think you can learn a whole lot in 15 seconds. In learning about something, particularly something that has a little bit of complexity like investing, does take time, and we encourage you to take the time to make sense out of all of these financial concepts. Our book, Next Gen Dollars and Cents, of course, a great resource for that. Available on Amazon and also available through our website. You always get a courtesy copy when you make an absolutely free consultation in our office. So that's another good way to kind of take advantage of that resource. Well, as always, we are here during the course of the week to help in any way we can. If there's a topic perhaps that you haven't heard us talk about lately on the program, feel free to reach out to us directly through our website at Nelson Financial Planning. Happy to talk about anything that might be on your mind. In addition, that's also where you can request a free conversation with any of our certified financial fiduciaries. With that, we're going to wrap it on up and get on out of here. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning.